Welcome to Talk Tickers. You're looking for the crucial takeaways from the latest earnings calls without having to wade through the hour-long presentations yourself.
That's definitely the goal.
Exactly. That's what we're here for. Today, we're diving into the first quarter 2025 earnings call for Independent Bank Corp, ticker INDV.
Right, INDV.
Our goal is to unpack the key financial results and management's insights, making sure you understand what really matters.
Absolutely. And looking at the first quarter of 2025, Independent Bank Corp actually showed some solid underlying performance.
Okay.
They saw growth in their pre-provisioned net revenue, which, simply put, is the money they made before setting aside funds for potential loan losses.
Got it. PPNR.
Exactly. This increase was driven by, a better net interest margin.
Yeah.
And it's the difference between what they earn on loans and pay on deposits, plus good performance in their fee-based businesses and pretty careful control of their expenses.
So keeping costs in check.
Right. And as a result, they achieved positive operating leverage. That means their revenue grew faster than expenses, both compared to last quarter and year over year.
That's always good to see.
Definitely. Their operating return on assets, or ROA, reached 1.52%, which is a pretty healthy sign of profitability.
Yeah.
And their tangible book value per share, a key measure of shareholder equity, improved by 1.8% from the last quarter, and actually a notable 7.8% year over year.
Sounds like a good quarter overall then, but I thought I saw something about credit costs being elevated. Was that right?
You're right, yeah. Well, the core performance was strong. Credit costs were higher this quarter.
Okay.
This was mainly due to their ongoing work, resolving some loans that had previously become, problem loans.
Okay, so that's the caveat.
Exactly. GAAP net income, which follows the standard accounting rules, came in at $44.4 million, or 1.14 cents per diluted share. That resulted in a 0.93% return on assets. The return on average common equity was 5.94%, and return on average tangible common equity was 8.85%.
And the adjusted numbers. Sometimes those tell a slightly different story.
They do. If we look at their adjusted operating results, which kind of strip out some one-time items, net income was slightly higher at $45.3 million, or 1.1 cents per diluted share.
Okay.
The adjusted operating ROA was 0.94%, return on average common equity 6.05%, and return on average tangible common equity was 9.01%.
So still decent numbers on an adjusted basis.
Yeah, and importantly, their tangible book value per share still saw a good increase, 0 to its 85 during the quarter.
Okay, so solid performance, but definitely with a bit of a headwind from these problem loans. Let's dig deeper into that. What exactly drove those elevated credit costs?
Yeah, sure. The main factor was resolving several significant non-performing loans, NPLs.
Right, loans not getting paid.
Basically, yeah. The largest of these was a $54 million office loan in East Boston.
Wow, that's sizable.
It is. The bank is aiming to resolve this through a property sale expected late Q2 this year, and they took a $24.9 million charge-off on it. Yeah, essentially writing off a chunk they don't expect to get back. Interestingly, though, this charge-off was slightly less than the amount they'd previously set aside as a specific reserve for this loan.
Oh, okay. So they were at least somewhat prepared for that hit. What about other problem loans? Any others stand out?
There was another significant one, yes. A $30 million syndicated office loan, this one in downtown Boston.
Okay.
This loan matured back in Q4 24, became non-performing in Q1 this year, and they took a significant $8.1 million charge-off.
Bringing it down to the property value.
Exactly. Down to its appraised value, as the group of banks involved tries to work out a potential modification of the loan terms.
Modifications can be tricky.
They can be. Then there was another office loan that's actually in the process of being sold, like a note sale. They've identified a buyer.
Okay.
That's expected to close in Q2 as well, and resulted in a $7 million charge-off, which actually matched the specific reserve they already had for it.
So that one was fully accounted for in reserves. It sounds like they're actively working through these issues, not just letting them sit.
Definitely seems that way. There were a couple more mentioned. A commercial and industrial, or C&I relationship where the collateral is being liquidated. Okay. That saw about $6.9 million in paydowns, reducing the balance to $4.8 million. But they also established another $2.5 million specific reserve just for that situation.
So still some risk there, potentially.
Potentially, yeah.
Yeah.
And finally, one more office loan being marketed for sale. It had an updated appraisal and liquidation value, which led them to add another $1.6 million to reserves.
Got it. So quite a bit of activity on the NPL front, but did they mention the overall trend for troubled loans?
They did. On a more positive note, the total amount of the commercial loans considered criticized or classified, showing potential weaknesses that actually decreased.
Oh, that's good.
Yeah, down to 3.8% of their total commercial loan portfolio. Overall, the provision for loan losses for the quarter was $15 million. And their allowance for loan losses as a percentage of total loans, that ended the quarter at 0.99%.
All right. So a definite effort to clean up the loan book, even if it means taking some hits now. Let's shift gears a bit. Talk about their overall financial foundation. How did the balance sheet and capital look?
Yeah, good question. Average deposits saw a modest increase during the quarter, but the period end balances, those showed a more significant jump.
Oh, really?
Yeah, up $370 million, or about 2.4% compared to the previous quarter end.
Where did that growth come from?
Mostly from non-maturity deposits, the checking and savings accounts across consumer, business, and municipal segments. That growth offset a slight decrease in CDs.
Interesting. And non-interest-bearing deposits, how are those holding up?
Still pretty strong. Non-interest-bearing DDAs made up a healthy 28.1% of total deposits at quarter end.
Okay. What about loans? You mentioned the charge-offs. Did overall loans shrink?
Actually, total loans remained relatively flat overall.
Yeah.
But within the portfolio, there were shifts. They saw a notable 2% increase in C&I loans quarter over quarter.
Ah, the commercial and industrial side.
Right, which translates to an annualized growth rate of 8%. And that reflects, recent hires and stated strategic priority in that area.
So they're intentionally growing C&I.
Seems so. On the flip side, CRE, commercial real estate and construction loans decreased by 1.2%.
Why was that?
Mostly due to scheduled repayments or amortization, plus that intentional effort to reduce exposure to transactional CRE, and of course the charge-offs we just discussed.
Right. And capital. Any moves there?
Big move there, actually. They significantly strengthened their capital position. They raised $300 million in subordinated debt right at the end of March.
Sub-debt, okay.
Yeah, that boosts their Tier 2 capital. Gives them greater financial flexibility for organic growth, maybe potential M&A down the line, even share repurchases.
That capital raise sounds significant. How does that tie into their net interest margin? You mentioned NIM improved earlier.
Right. So the reported NM on a fully tax equivalent basis did improve by 9 basis points to 3.42% in Q1.
Okay.
If we strip out some specific sort of outsized benefits, their core NM was 3.37%, still up 6 basis points from Q4.
And what drove that core improvement?
It was largely due to their position being relatively neutral to short-term rate changes by the Fed, and their assets being sensitive to moves in the middle and long end of the yield curve. Basically, the shape of the curve helped them a bit.
Got it. But what about the sub-debt? That has a cost, right?
It absolutely does. That recent $300 million raise is expected to reduce their standalone NM by approximately 11 basis points going forward.
Oof, 11 basis points. That's a decent hit.
It is, because they'll be paying interest on that new debt.
Right.
But despite this, their previous guidance for standalone NIM expansion of 3 to 4 basis points per quarter, excluding the impact of the sub-debt, that's been reaffirmed.
Yeah, okay. Assuming the yield curve behaves, more or less.
Exactly. Assuming the middle and longer parts of the curve remain relatively stable.
So a bit of a short-term drag from the debt raise, but the underlying trend in NIM improvement is expected to continue, just offset slightly. What about their other income sources and expenses?
Non-interest income, things like fees, wealth management income that saw a modest increase.
Okay.
Supported by higher wealth management income itself, and also more income from loan level swaps.
And expenses, you said they controlled them well.
Yeah, total expenses, if we exclude any M&A costs, remained fairly stable compared to Q4.
What kind of things move the needle there quarter to quarter?
Well, Q1 typically includes normal payroll tax increases, that seasonal thing.
Yeah.
They also had about $1 million in snow removal costs this time.
Ah, winter.
Yeah. But those were offset by reduced spending on consultants and some unrealized losses on equity securities they hold. Their tax rate for Q1 was about 22.3%.
Okay. Looking ahead then, what kind of expectations did management lay out for the rest of the year? What's the guidance?
Right, guidance. On a standalone basis, so just INDB itself.
For any merger impact.
Exactly. They're anticipating a low single-digit percentage increase in their loan portfolio for the full year 2025.
Low single digits. Okay, moderate growth.
Yeah. And they expect deposit growth to be in the low to mid single-digit percentage range for the full year.
All right. And provisions for loan losses. given the NPL work.
Due to the current economic uncertainty, they didn't provide specific guidance for provisions.
Understandable.
But they did say they anticipate further resolution of those large NPLs we talked about.
So more cleanup expected. What about non-interest income and expenses for the full year?
For both of those, excluding any costs tied to the pending acquisition of Enterprise Bancorp,
Right.
they're expecting mid-single-digit percentage increases for the full year 2025.
Okay. Mid-single digits for both income and expense growth, and the tax rate.
They project the full-year tax rate to be in the range of 22% to 23%, pretty consistent with Q1.
Got it. Let's definitely talk about that acquisition. What's the latest on the Enterprise Bancorp deal? That seems like a big one for them.
It is. And it's still expected to close in the third quarter of 2025.
So Q3 timeline holding.
Seems so. Management continues to express confidence in the strategic and financial reasons for the deal. They also highlighted, which I thought was interesting, that a significant majority of customer-facing employees from Enterprise have accepted offers to stay on post-merger.
Oh, that's huge for integration, isn't it? Keeping the frontline staff.
Absolutely. A very positive sign for a smoother integration. On a pro forma basis, looking at the combined entity, their commercial real estate concentration is expected to be just slightly north of 300%. And that includes the impact of the recent sub-debt raise.
Still above that 300% regulatory guideline, but maybe manageable with the added capital.
That seems to be the thinking.
Yeah.
Enterprise will also bring about $1.5 billion in assets under advisement, or AUA, to their wealth management platform.
Significant boost to wealth management.
Yeah, creates opportunities for cross-selling and scaling that business. One point of uncertainty, though.
What's up?
The ultimate impact of the purchase accounting adjustments, the fair value marks, that will depend heavily on where interest rates are when the deal actually closes.
The moving target of interest rates. Always a factor in bank deals.
Always.
It does sound like a potentially transformative deal. What are some of their key strategic priorities beyond just getting this acquisition done?
Good question. Even before the deal closes, they're focused on continuing to reduce their concentration in commercial real estate. That's still a priority.
Makes sense.
They're also prioritizing growth in business and industrial loans, B&I, as well as small business lending.
Aligning with that C&I push we talked about.
Exactly. That strategic shift towards C&I lending is key. They've made recent hires, as mentioned, to strengthen their capabilities there, and they're apparently looking to expand into things like foreign exchange and trade finance.
Interesting. Broadening the C&I offering?
Yeah. They're also sort of behind the scenes preparing for a significant upgrade to their core processing platform, FIS.
Yeah.
That's scheduled for May 2026.
Core conversion. Those are always big projects.
Huge projects aimed at modernizing their tech infrastructure. Beyond that, wealth management remains a key focus, looking for AUA growth and positive organic flows.
Right.
And finally, the softer stuff, but still important, emphasizing retaining talented staff and maintaining strong customer service through all this change.
It's definitely interesting to hear about that strategic shift towards C&I lending. Seems like a significant, deliberate move. Okay, before we wrap up, let's get to our This Is Not Financial Advice segment.
Yes, the fun part.
Where we explore an outrageous but plausible trade idea based on everything we've just discussed. What have you got for INDB?
All right, so given Independent Bank Corp's proactive steps, tackling those problem loans, their successful capital raise, which shows they can access funding even when markets are choppy.
Good point.
And the anticipated closing of the Enterprise acquisition, which promises future growth. One could consider a long position in INDV.
Okay, that's the straightforward, plausible part based on company specifics. Now, where does it get a little outrageous?
Well, to add a layer of hedging, maybe, and to potentially capitalize on the, let's say, broader uncertainties still hanging over the regional banking sector.
Okay.
You might simultaneously consider shorting a regional bank index, something like the KRE ETF.
I see. So long INDV, short the KRE. The thinking here is that while INDV seems to be navigating its specific issues and has a growth catalyst,
Right.
the wider regional banking environment could still face headwinds. Is that the idea?
Exactly. It's a relative value play, essentially. This strategy lets you potentially benefit from company-specific positives at INDV, the enterprise deal, the NPL cleanup, improving asset quality, while also providing a hedge against potential systemic risks or just broader negative sentiment that could hit the whole peer group.
So if INDV executes well, integrates enterprise, keeps cleaning up, it might outperform its peers.
That's the bull case for the pair trade, yeah. But If broader economic issues or, unforeseen problems hit the regional banks generally,
Yeah.
then the short position in the index, the KRE, could potentially offset some of the downside risk in your INDV long position.
That's a really interesting way to structure a view, focusing on a specific company's potential while acknowledging and even hedging against the broader sector context.
That's one way to think about it.
But as we always say, this is just a thought experiment based purely on our discussion of the earnings call today.
Absolutely not financial advice.
Definitely not. Make sure you do your own thorough research, consider your own risk tolerance before making any investment decisions whatsoever.
Couldn't agree more. And that brings us to the end of our deep dive into Independent Bank Corp's first quarter 2025 earnings call.
Yeah, we've covered the key financials, the strategic direction, those NPL resolutions, the Enterprise deal.
And even ventured into a wild yet plausible investment idea to get you thinking.
So what were your key takeaways from this deep dive? What questions are you maybe left with about Independent Bank Corp's path forward?
Thanks for joining us on Talk Tickers for another look into the financial world.
We'll be back soon with another deep dive.